Thank you for joining us for our monthly webinar series from Local Market Monitor, where we take a closer look at this month's National Economic Outlook, which was written by Local Market Monitor's president, Ingo Windsor. For those of you that don't know Ingo, he has been analyzing real estate markets for over 30 years and is a graduate of MIT and Boston University. He's not your typical economist and has a knack for taking complex data, extracting what is important, and providing unique insights and tangible guidance on real estate markets. So with that, I bring you Ingo and his insights on the economy.
Thank you, Carolyn. Every month we look at new data so we can get a better understanding of where the economy is headed and what that means for real estate markets. We mainly look at the growth of jobs because more jobs means more demand for real estate and vice versa. That's still a good idea, but during the last 2 pandemic years, job data were useless in predicting what would happen with real estate. During 2021, even as the economy was still short 5 million jobs, home prices in many markets soared. How that will turn out is still an open question, but it's plain that economic statistics are little help when other forces take over, like a pandemic or maybe a war in Ukraine. Fortunately, we mainly live in more settled times when economic data are helpful, but how we look at the data is an important part of figuring out what they mean. Through the pandemic, we've emphasized the depth of the job losses in various sectors of the economy in order to monitor the speed of the recovery, and also because it's likely that the pandemic would accelerate changes that were already underway, like online shopping, online learning, and more automation, as well as new ones we don't yet know about. These changes affect the economy as a whole, but are even more important for local real estate markets that can be disproportionately affected if hospitals manage with fewer workers, for example, or if people stay away from tourist spots. After 2 years of recovery and adaptation, we're at a point now where emphasizing how many jobs were lost is less important going forward than how many new jobs are being created. Recovering old jobs is one thing, creating new ones is another. So starting with the January and February data, for the major sectors of the economy, we're showing the increase in jobs compared to late 2021. That's what you see in red. On the left side, in green on this chart, we'll still show the history of job losses. I want to make clear that we're not showing different data. It's the same data, but seen from a different perspective. You see here why this change of emphasis is a good idea. Healthcare has been stuck at the same level of recovery for over a year. This looks like a structural change, not just a temporary one. Emphasizing how many jobs were lost isn't very relevant anymore. It's much the same in government, where it looks like 3% of the jobs that existed in government, which is mainly local government, for now at least, are gone for good. Since healthcare and government together provide almost a third of all jobs in the US, that means the economy has adapted to new conditions, and we need to start measuring those new conditions. In the business services sector, the change in emphasis is almost invisible, and it's a good sign that these jobs are growing at almost a 3% annual rate. Business services was the main engine of growth before the pandemic and probably will be again. In finance, it's the same story, where all the lost jobs have already been recovered. And in retail. In manufacturing, the situation is less clear. More automation has certainly eliminated many jobs, but new ones are also being created as more jobs return to the US. So our different perspective at the data will measure some of each. In construction, the recovery of jobs still lags a bit, but we'll mainly see new ones in response to the surge in home prices and eventually to new infrastructure spending. Restaurants are the one sector where what we'll show as new jobs will probably include a lot of recovery jobs. Almost 10% of jobs in this sector are still missing, but the end of COVID restrictions may bring more of them back. Where does this leave the overall job picture? Mainly because of missing jobs in healthcare, government, and restaurants, there are still fewer jobs than before the pandemic, but many of those jobs are gone for good. So it's an appropriate time to shift to a new perspective. The job data we'll show every month are exactly the same as before, but we'll see them from a new starting point. I've spent most of this time talking about jobs because in the long run, jobs run the economy and real estate markets. But right now, they have little to do with what's happening with real estate, a general surge of home prices, and in many markets, an outright boom. Next month, we'll look at this in more detail, but you can already note that the price increase in the fourth quarter, and this is for the country as a whole, which is measured from the same quarter of the previous year, is only slightly higher than it was in the third quarter. This suggests very strongly that the surge is peaking, which means prices will probably rise for another year, but at a slower and slower pace. That's it for today. That's it for today. In this time of uncertainty, let me plug our Investors Metro analysis, which shows how best to invest in this environment, how much risk you face in a local market, and the best rent range for investment in each local zip code. Available for 200 markets, it's as easy to use as 1, 2, 3. Thanks very much for following along. This is our National Economic Outlook. I'm Inga Windsor.